And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. It is, of course, September the 11th, of course, in memoriam of 9/11, 24 years ago today. So just, still, as we always say every year, we can always remember exactly where we were on that day when that happened. And, of course, it's always important not to forget that very tragic day in U.S. history. So, again, today, September the 11th, as we start up today. Today is also Inflation Day. So yesterday we had PPI that came out. Producer Price Index came in at 0.1%, much less than expected. Again, inflation doesn't seem to be an issue from tariffs at least, and that certainly helped move both bond prices higher yesterday as well as Fed expectations for rate cuts. Now pretty much guaranteed, kind of a lock that we'll get a rate cut next week. Next Wednesday is the next FOMC meeting. But today is CPI. Range of expectations all over the report, all over the board right now for CPI, running between 0.2, which is a long-term historical average. That's why every month they come out and say, what's CPI going to be? It's 0.2%. That's what it's been since the turn of the century. So it's just that's the kind of the average estimate, and that's why it's always been that way. But they run as high as 0.4%. So analysts are kind of all over the board right now, which probably means that inflation will come in at 0.1. We'll see what happens today. But that will also move the markets, and particularly will move the bond market to some degree. We'll talk about the bonds here in a second. But again, that's going to be kind of the last big report that we have right now before the Fed meets next week. So this is going to be kind of just cementing in that rate cut, but is it going to be 25 or 50 basis points? What's that going to be? We'll find that out. So again, we'll see what that report looks like today. But again, so far, there was this big concern that tariffs were going to cause all this inflation, etc. Has not been the case as of yet. And of course, we were writing articles before this happened, actually going all the way back to November, right when Trump got elected and started talking about tariffs. The big concern was like, oh, the Trumpflation is going to cause this. Like, hey, there's no history of this. The history of tariffs are not inflationary. That's because producers have to pay those tariffs, and whether or not they can pass that tariff on to consumers is the big issue. The one kind of interesting issue right now, though, is that corporate profit margins remain very elevated. And there's a very long historical correlation between corporate profit margins and GDP. And it makes complete sense, right? If the economy is growing, then margins should grow. If the economy is slowing down, margins should shrink. Well, right now, there's a big divergence right now between what's happening with corporate profit margins and what's happening with GDP growth. And again, as we are expected right now, quarter three GDP is tracking at about 1.5% growth. That certainly kind of underlies this whole problem with profit margins. So far, profit margins have been kept elevated through things like productivity increases with AI, employment reductions, layoffs, those type of things, cost cutting to a large degree. That's helped sustain that profit margin, but those actions are finite. I can't fire all my employees, right? I've got to have somebody that works. So again, one of the big risks for the markets going into the end of the year and really into next year more so than anything else is watching those profit margins. If those profit margins start to shrink a bit because the economy is slowing down, that could pressure the market overall, which again, valuations remain a kind of a key issue here. Forward earnings expectations still very elevated. But we are starting to see, and I warned you about this previously. I said, hey, right now earnings are very elevated, but they're going to get reduced as we start going into earnings. Well, already we're seeing that right now. Quarter three, quarter four earnings going into 2026 are coming down. We're starting to see those estimates come down as we're starting to realign kind of economic realities with those previous expectations. Markets aren't really paying attention to those cuts, but those earnings are getting cut. Now, 2026 hasn't gotten cut yet, but I expect that to also kind of come along as well. We'll update a report on that here fairly soon and kind of go through what's happening with earnings as well. But here's what you need to know before the bell this morning. Market yesterday had a good day. really, but if you take a look at really the heat map of the market, it was really only a few stocks. It was Oracle, Nvidia, Broadcom, and kind of AI related stocks. The AI trade was back yesterday. Everybody's like, AI's dead. It's not dead. It was just sleeping. It came back yesterday on Oracle's announcement that they announced earnings, and their outlook for AI construction was CapEx spending was extremely high. That dovetailed right into what NVIDIA had said also. Everybody kind of doubted NVIDIA's view. They said, we're going to have this massive CapEx expenditure over the next 3 years for these data center build-outs. And Oracle comes out and goes, yeah, they're right. And Oracle's shares were up at the peak yesterday. They opened up 33%, were as high as over 40%, closed at about 35% gain yesterday, but that lifted the whole tech sector, and that pushed the S&P up to an all-time high yesterday. So again, as what's important here is that we have this kind of running growth of the market. It's been running right along that 20-day moving average. Every time we come along and test, in the least test this 20-day moving average, that's been kind of a buy the dip moment for the markets, going all the way back to where we were back in April. But every time we've touched that 20-day, that's been, investors have stepped in and bought that dip. And right now we're sitting right here at all-time highs. One thing to just kind of pay attention to is that we do have a bit of a wedge pattern starting to build here with the markets. Again, that's just a compression of that price. We're trying to break out above that wedge pattern right now. But again, we're doing that on this, and we keep talking about this, on that negative divergence in relative strength and momentum. Again, those things don't matter ultimately until they do matter. But right now they don't matter. Markets are very optimistic, very looking at kind of this whole AI trade, what's happening. But again, you look at the breadth of the rally yesterday, it was not impressive. We saw a few spots of strength yesterday, but a lot of red really kind of across the map yesterday in terms of the market itself. But this was a very concentrated rally yesterday. One thing to also kind of look at here, as we said, is what's happening with bond prices, because again, this CPI report today will certainly kind of weigh on the bond market. And again, that PPI report yesterday, when it came in, initially there was kind of a bit of a knee-jerk reaction in the bond market. They didn't know exactly how to read it, but once they started kind of digging into that data yesterday, we continued to see another decline in yield. So yields are now very rapid. We're at 4.03% on the 10-year Treasury. If CPI comes in a whole lot weaker this morning, it comes in at a 0 or a 0.1 print, not saying that's going to happen, but if we do have some print like that on CPI and fairly weak internals, we could see potentially a 4% handle really kind of very quickly on bonds, because that's now starting to push that level. If this continues, we're going to start seeing more of that. We have a massive short position on treasuries. So if this yield drop continues, and we're starting to getting a lot more technical confirmation of that drop in yields, that's going to start that short covering potentially in bonds. And if you have to start covering that massive outlying short position in bonds, that's going to potentially drive yields a bit lower here. Again, we're on a decent, so again, this is interest rates, which are the inverse of bond prices. So we're on a decent buy signal right now for interest rates, suggesting that yields are going to go lower here, at least short term, but we are very, very, very overbought on this drop in yields. So again, nothing would surprise me to see a bit of a pop in yields. And again, that would be an actual kind of a decent opportunity to potentially add into bonds or to play against a treasuries drop. Because again, we're starting to see the backdrop technically improve, becoming much more bullish for bonds overall, at least here in the short term. Again, that's not a long-term trade, that's just short-term analysis. But again, a bit overbought here. So again, a bit of a reversal in yields would not be surprising, but it would probably give you a better opportunity to add some fixed income to your portfolio if you need it. Anyway, that's what you need to know before the bell this morning. We'll come back. We'll talk a little bit about markets, kind of what's going on in general, and then kind of what to expect from here. So don't go away. More coming up on The Real Investment Show.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
And now, Another page from the Real Investment Advisor's Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And good morning. Welcome back to the show. Hold on a second here. Just trying to get my act together. It's Thursday. Second best day of the week. Michael Leibowitz not joining us this morning because he is lounging in a mankini in Greece today. So he'll be back next week. But yeah, he is on his last summer vacation right now. So he'll be back next week. So just to cover really kind of a couple of things. One, just talking a little bit about Oracle and that announcement yesterday. It was very interesting. So we actually have, we launched on SimpleVisor. We launched a series of portfolios that are on SimpleVisor now that are more thematically based. And what these you kind of were providing is an opportunity for investors to, pick up some very specific kind of thematic type portfolios, for kind of building out kind of whatever your structures are. So, the AI trade's been very popular, the crypto trade. Brent, you can bring these up for me. Is an opportunity for we have a portfolio, for instance, pick up AI portfolio. We have one that's all weather, which has a lot of gold, precious metals, these type of things in it for kind of building out just simply kind of whatever your structures are. Portfolio, the AI trade, which is kind of playing on that whole build out of kind of an opportunity for we have a portfolio, for instance, pick up AI portfolio. We have one that's all weather, small mid-cap stocks, crypto, precious metals, which has about a 40% weighting in actual kind of building out just simply kind of whatever your structure are. Accumulator model, AI trade, which is kind of playing it out, whole build out basic ETF portfolio. And these are all budgets for the United States. We have a AI AI portfolio. We have one that's all small mid-cap stocks, crypto, precious metals, which has about a 40% weighting in actual kind of building out just simply whatever your structure are. Accumulator model, AI trade, which is kind of playing it out, whole build out. It just had such an outside based. We have a AI portfolio. What was it? Small mid-cap stocks, crypto, AI, which has about a 40% weighting in actual kind of building out. Just it's interesting because accumulator model, AI trade, which is kind of playing it out, whole build out. It just had such an outside based. We have what's interesting about these portfolios, and if you think about this, and is that these are like factors. And we talk about factors in the market, right? So we talk about, high beta and low beta stocks. We talk about these different types of things. But these portfolios, when they're running live now, these are like factors of the markets. And it's just very interesting to watch these portfolios and look at what the overall market's doing. And you can kind of see these pockets of speculation that are popping up within the market. Like, for instance, in one of the portfolios, we own a stock called Bloom Energy, which, again, we just bought this stock, this company, maybe 4 weeks ago. And I just thought it was interesting because, that stock, just since we bought it, is up like 75% in like 4 weeks. And that's just showing that kind of speculation that we're driving within the overall markets right now. And, so again, it's these types of things that make me kind of sit back and go, maybe we need a little bit, be a little bit more risk averse here. There doesn't seem to be any risk in the markets, kind of whatsoever. And there doesn't seem to be any type of real worry about a correction. Take a look at the volatility index as a function, very, very low right now. Volatility is very compressed. There doesn't seem to be, any type of concern of a correction. Investors aren't willing to go out and pay for insurance, against the markets. And then you kind of see this more speculative fervor in some of the more highly kind of risk areas. Again, I'm not saying that stocks are risky. I'm not saying that at all. But there's when we're looking at the amount of volatility and talking about volatility in terms of risk management, we're seeing a lot of push in areas that are highly volatile and highly subject to economic outcomes. And there doesn't seem to be a lot of concern about that. And so one of the things that we kind of look at on a regular basis when we're having our morning meetings and talking about investment management, these type of things, and is looking at these different kind of sectors of the markets and these factors. And it just kind of gives you this idea that while markets are doing okay on the surface, everything's doing great. But that's also kind of a concern. Everything's doing great. Bonds are doing good. Gold's doing great. Miners are doing fantastic, which are very poor allocators of capital. Stocks are doing great. Small mid caps are doing great. I mean, everything's doing great. There's nothing that's not working right now, which is, in a way, it's good, but it's also concerning, just from a contrarian point of view. And again, this is always kind of the point about risk management in a portfolio, is just kind of saying, okay, everything's great, everything's doing well. What's the thing I need to watch out for? And that's the kind of the overall driving concern right now. There's just a lot. And again, now remind you, we're coming off of 20% years in a row, and we're rapidly approaching another 20% year this year. If this market rallies into the end of the year, we'll be close to a 20% return by year end, if we kind of keep going at the rate that we're going. So again, that's nothing wrong with that, right? Everybody's making money. This is a good thing, and I don't want to deter you from making money. I don't want to deter you from being invested at all, because you should be. You need to have money invested in the markets. It's just you have to start asking yourself the question of what if. Right? Kind of this whole greed factor bias behind the markets has gotten, it kind of gotten a little bit out of hand to a degree. We talk about, when everybody's all in the pool, right? What happens when somebody starts getting out of the pool? And it's one of those things that kind of builds slowly at first, but then begins to gain traction as more and more people leave the pool. Now, right now, nobody's leaving the pool. Everybody's swimming in the pool. It's all great. The water's warm. It's all fine. And it doesn't really matter what asset class you own. It's doing well right now. Now, some asset classes are doing better than others. Not denying that, but I'm just saying is it really doesn't matter what you own. If you've got money invested, you're making money right now. And then that kind of brings me to this other factor that I'm starting to get a lot of emails about. Lance, why are you worried about this? Everything's great. Just buy more stocks, get more aggressive. Starting to get a lot of people, in our clients that are normally very conservative. They're saying, why don't we increase the equity amount in our portfolios, right? Why don't we take on some more risk here? Why don't we go to, from 60% stocks to 80% stocks? And it's like, slow your roll here. It's all fine and dandy right now. And it's easy to be aggressive when markets are going up. It's easy to be optimistic. It's easy to be greedy. It's like, oh, I'm not worried about anything. It's just going to keep going up forever. Things don't go up forever. And that's going to be the issue that eventually comes back to roost in the markets, is that eventually we're going to see some type of reversal, and that kind of that rush for the door is the thing we're going to have to pay attention to. And again, we've got a couple of things coming up right here at the end of the month. We've got quarter end rebalancing, and right now there's a lot of stocks that are over their weights. Again, like I was just talking about with Oracle and those two portfolios on Simplivisor, that I went in yesterday, I just trimmed them back to portfolio weights, right? They were just really outsized their portfolio weight, so I just rebalanced them back to their portfolio weights. I'll probably do that again and rebalance all the portfolios back at the end of this quarter. And there's a lot of stocks that are very overweight their sectors, right? Bloom Energy, Arista Networks, those type of things that are in those portfolios. Broadcom in those portfolios have had big runs over a very short time frame, and so they've got, if their normal weight is 5%, they're now trading at 6% of the portfolio. So you just trim those back to 5%. But if I'm doing that and everybody else is doing that also at the end of the month, there's a risk that as we get to quarter end rebalancing, we could see some pressure within this market as just that rebalancing occurs. And there's a good bit of that overweight right now within the overall market. So, again, the risk is not off the table. Again, we're not talking about, I don't want you to think I'm saying we're going to crash. I'm not saying that at all. I'm just saying there's a bit of risk here that A, you have a very high level of complacency in the markets, and B, you have this event coming up at the end of the month, which may be nothing, maybe rebalancing is absolutely nothing, but there is a bias towards there being a good bit of selling pressure, particularly in small and mid-cap stocks, particularly in areas like technology that have had very big runs over this last quarter. And we're coming up to the end of the quarter. So remember, count backwards, like September, August, July, right? So those have been very big months for the markets. So a lot of those positions are now a bit out of balance. So again, I don't want you to be concerned. I'm not telling you that you should go sell everything. I'm not saying that at all. But I am suggesting that there is some risk here, and the fact that we're very optimistic, very stretched, those type of dynamics. Maybe you just kind of look at your portfolio and say, kind of what do I need to be thinking about in terms of my overall risk management. So anyway, I just thought those factors were interesting. It's just, again, we started those portfolios like 3 months ago, and they're just going gangbusters. And I'm just like, that's not normal. You should not be getting a year's worth of gains in like 3 weeks. But that's what's happening in the markets right now. And again, it's great. It sure makes it easy for me to sleep at night because I don't have to really kind of worry about portfolios very much. But, definitely something to pay attention to. So a couple other things to kind of talk about this morning. Again, just, there's a few things that are going to be happening. So, as we kind of just today in particular, we have this CPI report that's coming out. And I wanted to show you this chart because this is kind of emblematic of kind of what's going on with Wall Street at the moment in regards to the CPI report. This is a chart this is basically just a quick table of the spread between analyst estimates. And this morning, the analyst estimates for CPI are literally just all over the place. Again, as I was saying earlier in the show, the average rate of return, if I look at CPI going back to 2000, and I look at the average monthly change of CPI, it's 0.2%. Okay, do some quick math here. I know it's early in the morning, but you're going to do some quick math. 0.2% times 12 months is 2.4% growth in CPI annually. That's what the annual growth rate in CPI has been. So when the Fed talks about our 2% target, it's 2.4%. It's not 2. It's 2.4. The average rate of inflation since the turn of the century, and that makes you feel old, has been 2.4%. So when the Fed talks about their 2% target, it's 2.4. And that's why also every month, everybody comes out and says, what's your estimate of CPI? 0.2. Because that's what it's been. So it's a good, safe estimate. Estimates right now, though, all over the board got anywhere from 0.2 to 0.4. And this is the, kind of the problem. Now, again, we've seen this kind of historically before, but the estimates right now. So here, let me give you some of the quick estimates. You can pull this down for me, Brent. Some of the quick estimates right now. So headline CPI is I'm going to read this to you real quick. Headline CPI is expected to rise 0.3% month over month. That's an acceleration of from the 0.2% rate last month. That translates into kind of a headline CPI of 2.7% to 2.9%, somewhere in there. This morning. That's probably a high number because if you take a look at the 40% component of CPI, which is housing, that's been declining. And we're starting to see more and more pressure on both rents as well as homeowners equivalent rent as well as home prices. That continues to weigh. So there's a higher potential probability. While the average estimate is a 0.3% increase today, there's probably a better than 50% chance that number is going to come in weaker than 0.3% because solely of what's happening in housing. Also, oil prices, which feed into everything else from transportation, everything else has been under a lot of pressure. So that decline in oil prices is also going to feed into kind of that disinflationary pressure into CPI as well. So don't be surprised if we get a 0.2% or less reading this morning, even though the average estimate's of 0.3 right now. Core CPI is expected to rise 0.3. That's the same as last month. Expectations for core CPI to have a normal, if slightly top-heavy distribution centered around 0.3. 13 analysts are expecting 14.4%. But again, this is kind of the overall. And when you kind of break down, kind of CPI itself, look at, and this is a chart. This is a chart of the weightings of the different components of CPI, whether it's apparel, new cars, motor vehicle parts, tobacco, etc. The weighting is on the left, right? Pay attention to the weighting, right? This is what I'm trying to say, is that when you start scanning down this, you get into everything that's housing related, right? That's what's weighing on. When you have a 33% weighting of homeowners equivalent rent by itself, not including household furnishings and other stuff that goes into housing, but just looking at the rent component, that's a third of the overall makeup of that index, of that weight. So it really doesn't matter if, the cost of having a pet goes up 10%, but it's a 1% weighting. It doesn't move the needle a whole lot, right? Public transportation is 2%. Medical care, right? Medical care can go up and down a good bit, but it's only 8% of the index. So it's got to move a whole lot to really have a big weight. So in other words, if you're seeing homeowners equivalent rent just by itself, just that number, right? Not including everything else that goes around that sector, but just that number of homeowners equivalent rent, if that's moving down, everything else has got to be moving up a whole lot, right? And so the reason that, when we talk about, kind of the rent, issue of housing and that housing component of CPI, 33% of its homeowners equivalent rent. If you scan up from that level, look at rent of primary residence, that's another 9. So 42% is all related to housing. So it doesn't really matter what else happens in that index to a degree. It does. I mean, if everything else is in the index is going up and only housing's going down, then inflation will go up. But it's hard to offset, particularly in this environment right now, when you've got 42% of the index in total tied to housing, and that housing number continues to weaken. It's going to be really, really hard to get a big spike in inflation. This is why tariffs haven't been a problem for CPI, because tariffs have nothing to do with housing. You don't tariff your house. You don't tariff your rent. So tariffs don't show up in CPI, and this is where the Fed's been dead wrong, worrying about these tariffs being an inflationary impact on the economy, because housing was always outweighing everything else in the index. So again, this is why probably today, again, we could have some outsized surprise. We'll see. There's no guarantees of anything, but I would not be surprised to see a 0.2.1% print in CPI today. It wouldn't surprise me. Again, it could be 0.3. We'll see what happens. But just, again, this is why, again, when we take a look at, CPI itself, what everybody tends to forget is, they look at they focus on the cost of eggs or the cost of ham or whatever else they're buying. And stores like, have you bought ham lately? Ham's just crazy. But the reason that doesn't show up in CPI is because of that weight of that housing. Just those two components, the 33 and the 9, you stick those together. That's 42% of the index. Very, very hard for eggs to move the price to move overall inflation. This is why we get so frustrated with the inflation data. It's like, I don't understand. If you go to the store, it's just everything's so expensive. Yes, it is. It is very expensive to go buy groceries. It's very expensive to eat out. Can you bring up that chart for me one more time, Brent? But when you start talking about, things that you actually buy at the store, right? Tobacco is 1% of the index. Alcoholic beverages, 1% of the index. Personal care, we buy that at the store, right? 3% of the index. Energy is tied into things like transportation services, public transportation, oil. If you'll notice in here, oil is not. There's no spot in here for oil. Right? We don't have one for oil prices. Is there inflation in oil prices? Yes, there is, and it's included in all the things that use oil, like used cars. but we don't have a percentage weight just to oil. But again, when you take a look at here, medical care, things that we buy, things that we pay for, and commodities, as well as just healthcare services itself. But this is why, again, when you look at those type of things, the things that we're buying at the store have very small weights in the overall index, and that's why they don't move that needle much. Okay, so but CPI out today. We'll pay attention to what happens there, and kind of go. Well, the other thing to start kind of paying attention to as we kind of wrap up this quarter, and we're going to move into next quarter. When we get into the last quarter of the year, there's a lot of things that are going to start happening within the overall market to pay attention to. One of those is that, first of all, we'll have corporate buybacks will come back. So again, starting next week, that window for buybacks is going to shut. So all the companies getting ready to start reporting in October cannot buy back stock. Now, technically they can. This is kind of a misnomer. They could be buying back stock. They just generally don't. There's just kind of a rule of thumb. They don't want to run afoul of the SEC. So a lot of companies just have basically a 2-week window where they say, hey, we're going to be announcing earnings next 2 weeks. You can't trade stock. If you're an insider of the company, you can't trade stock for the next 2 weeks, right? You can't buy or sell, can't do anything until we announce earnings, because they don't want to get tagged for insider trading. Somebody goes and sells a bunch of shares right before the earnings announcement, and there's a big miss, and there's concerns about insider trading. Companies don't want to deal with that, so they just kind of shut that window. No corporate buybacks during that 2-week period, and so that's going to remove a buyer from the markets. But that window is going to open right back up again around the end of October. So this is why historically going into November and December, those typically tend to be much stronger months of the year because you have that corporate buying kind of coming back in place. The other thing as we get set up for the end of the year is that there's a lot of, again, you look at systemic positioning right now between what's happening with the hedge funds and pension funds, mutual funds. They're underweight equities. They haven't been real heavy buyers right now of equities. Then they've been playing it pretty, kind of very cautiously relative to the rest of the market. Again, when we look at the rest of the market, retail investors are just buying every little dip that comes along. Every little dip to 20, they're in there buying it. They're buying more aggressive positioning. Well, a lot of the hedge funds, et cetera, have been underweight, particularly they're underweight technology stocks. So going into the end of the year, there's going to be a bit of a push to play catch up in terms of allocations. So as we kind of, start looking at this kind of end of the year process, it's very likely that we're going to continue to see this kind of push. Now, what I would have loved to have seen, which would have been a lot better if we could have had a bit of a correction here in September, August, September, kind of reset the market a little bit, kind of work off some of this, kind of deviation from longer term means. That would have been a better setup going into the year. Doesn't mean we can't have a correction in November. Typically, we have a market correction early December as we start to see mutual fund distributions. Generally, in the first 2 weeks of December, you typically get a bit of a pullback in the market. And we saw this last year, had that bit of a pullback, and then markets kind of rallied into January, struggled around a little bit, then took off again. So as we start getting into the end of the year, we'll see kind of those mutual fund distributions for capital gains, interest income, dividends, those type of issues. That will give you potentially an entry opportunity. But between now and then, that risk of a correction right now, if we don't get a correction in the next couple of weeks, the risk of a correction is going to fade pretty quickly because, again, that general bias and that catch-up for the end of the year is going to start pushing markets again. Again, it would have been better if we could have had a bit of a pullback or a bit of consolidation or something going into October. But just seasonally speaking, there's a lot of kind of catalysts that are going to start setting up for that end of the year push, and particularly in an environment where a lot of managers are trailing performance this year, they're going to have to be playing catch up on a variety of different fronts. So again, just things to think about in terms of portfolio risk management. I know there's a lot. I'm getting a lot of emails like, man, it's very interesting right now because I'm getting two different types of emails. I get one email, like I said earlier, is like, we need to take on more risk. And then I get other emails saying, don't we need to be selling stuff and getting out of the market because this huge crash is coming? There's no evidence of that. And there's no evidence that we're going to have one near term. Every week in the newsletter, I post several things. And there's some charts and graphs that I post in the Bull Bear Report every single weekend that are worth paying attention to. And I'll show you one in particular. Every week we post what's called a risk range report in the newsletter. Now this risk range report also runs live on a daily basis on SimpleVisor. So you can go to SimpleVisor and actually go to the do-it-yourself section and look at the risk range report. But I want to show you this report because this report is very important to managing your portfolio. Now, what this risk range report does, sorry, we jumped. Let me pause that. What this risk range report does, and back it up just a little bit, Brent, because I need that far right-hand column. It lays out, it looks at the standard deviation of how much a sector moves in a given month. So if you look back historically, basic materials on a monthly basis may increase or decrease by 1%. Technology may increase or decrease by 2%. Healthcare may increase or decrease by 1.5% on a monthly basis, historically speaking. So what it does is what this table does is it looks at the average move or the average volatility of a sector in a given month or market. And so we have in the top section, we have the 10 sectors of the market. Then we have kind of high dividend yield S&P and equal weighted S&P. And we have small cap, mid caps, emerging markets, international, gold miners, the dollar, and then bonds at the bottom. And so each one of these sectors are measured for monthly volatility. Now, there's a couple of important things in here. We provide the short-term weekly moving average and the long-term weekly moving average, and we look at the month-end price. So again, this starts at the beginning of the month and then measures it for the month. And so we start with the month-end price. We say, okay, what's historic? Where did we close the month, and how deviated are we now from where we closed at the end of the month? So this table resets at the first of every month. So when a sector or market trades well outside of its risk range, what it normally trades in a month, that's kind of a warning flag. So for instance, when I posted this last week, gold and gold miners were already well outside because of that run they've had. They're already well outside of their normal risk ranges for a given month. Energy was well under its risk range for the month, so that's why it's green. But what I want you to really focus on are the last three columns. And most importantly, the very last column. The last column is looking at the weekly moving averages. So we use a short-term weekly moving average and a long-term weekly moving average and basically build a bullish indicator. If the short-term is trading above the long-term moving average, that's bullish. If the short-term moving average is trading below the long-term moving average, that's bearish. Now, back at the beginning of this year, 15 of those indicators were bearish. We're now down to 3 as of last week. Now, what that says is that more and more and more of the moving averages, these long-term weekly moving averages, so these are slow to move. These aren't daily moving averages, so these are more about trending markets. What this is telling you is that with more and more of these markets turning bullish, the risk of a near-term big correction, like a 20 or 30% correction, is becoming less and less and less because you're getting more and more of these markets in bullish trending movements. If we start to see these bearish crossovers begin to return, right? You start to see one sector break down, then you see another sector break down, you see a market breakdown, crossover. that's telling you there's internal weakness building in the markets. And that's when you start seeing this going from 3 bearish to 4 bearish to 5 bearish to 8 bearish, that type of thing. The market may still be going up, even though you're starting to register some of these internal dynamics that are getting weaker. It's telling you that there's risk building in the markets. And that's where you can get these 20, 30% corrections. And for instance, if we go back and look at this table in 2021, that's exactly what we saw. We saw some of these bearish crossovers that were forming. We had, everybody was bullish in 2020 to early 2021, and then we started seeing some bearish crossovers as we headed into late 2021. And we actually kind of wrote a report that says, hey, this time to take profits, and you start to rebalance risk. We're getting a lot of these bearish crossovers, and that's going to potentially lead to a correction of the markets. And of course, 2022 markets were down, 20%. We don't have that dynamic right now. Right? Things are actually improving market-wise, not getting more bearish. And so while there's a lot of bearish headlines out there, it's like, oh my gosh, it's the death of the markets, AI is going to blow up everything, whatever. The market's not saying that. And again, the one thing that we want to pay attention to more than anything else is just kind of pay attention to what the market's telling us. And that's why, again, so if you subscribe to the Bull Bear Report, you can either subscribe at our Substack account, go to @LanceRoberts on Substack, you can subscribe there. I'll email it to you. Subscribe on our website. Just click the subscribe link top of the website. That'll help you as well. We'll get that email to you. But every week I post this risk reward analysis in that report, and that gives you kind of some good indication about what's happening with markets, where things are trading. Are you really overbought, extended? Should you take profits here? Should you take profits there? We kind of go through all of that. And we also post our fear greed index as well. We post our technical gauges as well. Those are just good kind of risk management tools. It's all free, by the way. But those are really good risk management tools just to kind of pay attention to what's going on with your money. And again, so those are there. And again, we kind of go through a lot of this. Is another chart that we publish in that same newsletter, which is just looking at the relative performance of markets and sectors. And right now, this is as of last Friday. So I'm sure if I run this as of when I run it this week, we're going to see a lot more of the bullish showing up today. But every sector and market is bullish this year. Nobody's losing money. That's unusual. The deviations from the 50-day moving averages are getting more extreme. So we're, again, just seeing a lot of very bullish bias in this overall market. Again, it doesn't mean the markets are going to crash, right? But these are things that we publish every week for you in that newsletter, and they're really good tools just to kind of look at your own exposure and saying, where do I have some potential risk? When you go back to that risk range report, there's you can look at the deviations from the long-term means. When you start seeing a sector trade 10, 12, 15, 20% from its long-term mean, that's really, really extended. And you're going to get a correction at some point. Now, what causes the correction when it happens, don't know. But it's going to happen. And that occurs in every asset class. There is no asset class that's immune from it. So while things are maybe very bullish right now, when you have these very big extensions, that's a really good time to come in, take some profits, rebalance some risk, and kind of put some cash on the sidelines and look for the next opportunity to buy back on that correction whenever it occurs. But those tools are there for you. Again, it's just we publish this stuff, and we try to help you kind of get there to help you manage your money a bit better. But again, all this stuff's at the website. And we can certainly find it there. And we're doing a lot of upgrades to the website as well right now to help things kind of navigate more easily. So again, if you have any questions, just go to the website, hit the Ask a Question button, send us just contact us, send me an email, say I've got a question about this, question about that. Always happy to help you out. All right, well that kind of wraps up the show for the day. Again, we'll be back tomorrow, Financial Fitness Friday, of course. Markets are, going to open up again this morning to the positive upside. The big news today will be CPI. That'll be driving the bond markets as well as the stock market. But again, everything's fine, right? There's nothing to worry about at the moment, but just don't forget about risk management.
That's the only thing to really worry about right now is just how much risk you're taking. All right, have a great day. Be back tomorrow. Thank you for joining this morning. Be sure and like and subscribe to the channel. We do appreciate it very much. We'll see you tomorrow.